Okay, so this is the basic operating cycle. Okay, so each of these we're going to cover kind of separately because they each are accounted for a little differently. So this first one is the purchase of inventory. Okay, so we're going to kind of start with that, but I'll just walk through what happens. So you buy the inventory. This is going to be held on the balance sheet as an asset. The second step is you sell the inventory. So this is where it goes cost of goods sold. So there's one journal entry for revenue and a second one for cost of goods sold. So that inventory gets expensed as cost of goods sold. If you sold it on account, you have some account receivable, and then eventually you get that cash, and then you're going to buy more inventory. And this cycle is just going to repeat. So this is kind of the operating cycle. So we're going to take this one at a time. We'll start with this purchase of inventory. Um, this invoice, I guess, is kind of it's general because when you are buying inventory, you're going to receive an invoice. When you're selling inventory, you're going to give an invoice. Okay, the parties are just going to be kind of swapped around. So in an invoice, you're going to have who the seller is. So you can see, I guess this is from our supplier, our vendor. So we are the buyer in this case. This is our company. You're going to have some date of the invoice. This is going to be important because the inventory or this purchase is going to have some time period where you got to pay this off, and it's going to start from the date of the invoice. So the date of the invoice is important. Okay, um, it's also going to be relevant for your accounting books because this is going to be kind of like a transaction, and it's going to be dated as of the time of this invoice. This is what we call credit terms. This is going to specify within what period of time are you allowed to pay this off before the vendor is going to be pissed off. And we're going to see some other things where they want you to, is the vendor wanting you to take your time to pay or to pay you sooner? What's better for them? Sooner, right? Because they got expenses to pay. They got to pay their workers, they got to pay their utilities, they got to pay for whatever, like if they're a manufacturer, they got to buy all the raw materials. So they want that cash sooner. So they will oftentimes offer the customer some incentive to pay fast. Okay, so we're going to talk about how that is kind of spelled out in a second, but it will be on the invoice somewhere. You're going to have kind of what the items are, their item SKU number, right? There's some identifying, probably like a some identifier. It's usually some kind of inventory, like a number or like some way to identify what they are, a description of what they are, how many, so the quantity, per unit cost, and the total, which is just the quantity times the unit cost, right? So 100 times 5 is 500. 50 times 10 is 500. Okay. And then you have your subtotal and the total due. Okay. So pretty straightforward. I think we've all seen this. We've all ordered stuff. We all kind of have seen an invoice, yes, to some extent or another. I think the only kind of new thing is these credit terms. Okay. So the way this works, so this is a typical credit term, the short form of it. Okay. So it says, let me zoom in here. 3-15, comma, N30. So what does this mean? It means that the vendor is like, if you pay me within 15 days, I will give you a 3% discount. Okay, so in the case of this $1,050 invoice, you could multiply this by what to get a 3% discount? Okay, yeah, to get 3% is this times 3%, or you could do this times 0.97, and that's going to give you how much you have to pay, right? Agree? Okay. If it takes longer than 15 days, then the N stands for just the net amount, like the total, within 30 days. Okay. So you either can pay me 97% of it if you pay me within 15 days. So I'm going to give you a little discount, or I'll give you a total of 30 days, but then you got to pay me from day 16 through 30. You got to pay me the full amount. And after 30 days, you're late, and maybe I'm gonna have to do something about that. So there's different permutations of this. Okay, so think about what these mean. Okay, these are different terms that you may see. Okay, and I'll give you a hint. The vendor does not have to offer you a discount. They can choose to do that if they want the money sooner, right? Because they're giving you an incentive to do that. So make sure you're clear on what is being offered here. Okay, so take a second, look at these, think about it, and then we'll discuss what they are. The 110 N45. This is like by itself, okay? This you could see this as one credit term that's offered. Okay, so it means 1% discount if you pay within 10 days of the invoice. If you don't pay within 10 days, you have a total of 45 days to pay, but you have to pay the full amount. Okay, what about this? Exactly. There's no discount. You just have 60 days to pay off the full amount. Okay, so as I said, the vendor does not have to offer a discount. They can just specify you got to pay me the full amount and just however many days that they're going to give you. Okay, so now let's apply the same pattern to the next one. The only thing with this is what does this EOM stand for? Anyone know that? End of month, exactly. 220, meaning 2% discount. You have 20 days to avail yourself of that discount. Else, you have to pay the full amount by the end of the month. Okay, so the invoice date is going to matter because you're going to have to see, okay, from the time of the purchase or the sale, when is the cash coming in, and you have to see if it's within this discount period, if a discount was offered. Okay, and that's going to affect how you do your accounting. So you need to be familiar with what these terms are, okay, because it's gonna affect how you can do your journal entry. Okay, so the shipping also matters, and there's some terminology that we should just talk about. FOB, okay? This is like a shipping term. It stands for free on board. Okay, it basically uh, it's gonna be where ownership is exchanged. So FOB Oakland Port. Okay, if you had some shipping, if you bought something from Vietnam, okay, and the terms of the sale is that it's FOB Oakland Port. Okay, that means the person that you're buying it from, it's their responsibility and their liability to bring the goods from their location to Oakland Port. Okay, that is where you will then take ownership, and from then on, you got to transport it. You got to pay for the insurance. You got to insure against the loss, right? So it's a really important term. It's where the responsibility is exchanged, okay, and the cost, right? So if you were to buy goods from this Vietnamese vendor, uh, and they're like, "Hey, it's $5, okay, per unit," is it $5 FOB Oakland Port? Is it $5 at whatever, like Ho Chi Minh City Port? I don't know if that's like a port city, but it's the only city in Vietnam I can think of off the top of my head. Um, so it's going to make a difference because the shipping cost is probably going to be something of substance. So it's relevant. It's an important term to consider because the transportation is often, since we live in a world where there's a lot of long distance trade, this term is going to matter. Okay, so in these two examples, FOB shipping point, if you're buying it from the seller's location, you have to pay for the shipping to get it to your location. You have to pay for the cost of the shipping, the insurance. If something happens to it, it's like on you. Okay, you're taking liability for it at this point. If it's FOB destination, meaning the exchange happens at your location, then the seller is going to pay for the shipping. They're going to pay for the insurance. They're going to insure against loss. So that's going to be like a significant advantage. So uh, even though you can buy an item for $5 per unit, which one would you rather have? Which one is better, left or right? Yeah, this one, right? Because it's this price and you're getting it delivered to your location. this might be $5 per unit, but then you got to pay plus $1 for shipping, So it's actually $6, apples to apples. The discount, okay, we talked about this, the credit terms. If you did have to pay for freight, this discount does not apply to that because whoever's providing you freight is probably like FedEx or some other logistics company. They're not involved in this, 220 net 45. That's like between you and the vendor. They just want to get paid whatever their freight is. So if you're paying for freight, that early payment discount is not going to apply to that cost. It's only going to apply to what you're paying to the vendor. The key thing to consider here. So we're going to see freight both in the case that we're buying inventory and when we are selling, we may pay for freight to sell the thing. The treatment of it is totally different. Okay. When you are paying for freight and you're buying the inventory, it's going to be capitalized. It's going to be accounted for as an asset. When you are paying freight to ship it to your customer, that's going to be expensed right away. Okay, so this is an example of you got to be very crystal clear whether you are the buyer of the inventory or you are the seller, because you may have a inventory or like an invoice from FedEx, but you're going to account for it differently, whether that was for inventory you purchased versus inventory you're selling. I just want to state that explicitly because this is something that is easily confusable because you're going to see you paid for freight for this particular transaction. Your next question should be, well, did I buy the inventory? Did I sell it? Because there's going to be two different journal entries depending on the answer to that.